All right. Hello, everyone, and thank you for tuning in to this first time home buyer webinar. If you're here today, we're excited to have you, and we're going to share exactly what you need to know to buy a home in 2026. So we will hop right into it, and I will start out with sharing my screen. All right. This is how to buy a home. And we are the Schwaegerle real estate team. We are a husband and wife real estate brokerage. We're independently owned and operated right here on the Central Coast of California. I'm a third generation real estate investor and broker, and we believe in buy and hold real estate as one of the best ways to build wealth. And this is my wife, Camille, and our three kids, and we are very involved in our community. We do things like food drives, we give back, and we all believe in education and empowerment. So, the Schwaegerle team, we have our values. Our mission here is to connect with individuals to achieve their real estate dreams, experience financial freedom, and love where they live. And so, our vision is that California will become a happier and more wholesome state because it's filled with people who love where they live. So, how do we do that? Well, we help people buy, sell, and invest in real estate. And what is real estate? And I used to think it was like the house. That's the house. That's the real estate, but it's actually the land. And so here's a preamble of the Realtor Code of Ethics. Under all is the land, and upon its wise utilization and widely allocated ownership depend the survival and growth of free institutions and of our civilization. We're about to celebrate 250 years as a country this July 4th, and I'm very proud of our country being one of the first countries in the world that piloted land ownership for the masses. Back in Europe, you had to be born into the right family to own land, and here in America, we gave land ownership opportunities to people of all types, which had never been done before. So land, what is it? It's vacant land, like there's a dirt lot right there we've sold in Morro Bay. It's homes, like this house right here in Paso Robles that we had sold. And it's also commercial buildings like this commercial property in San Luis Obispo. So are we in a seller's market or a buyer's market? Pop quiz. Hello, Caitlin. Welcome to the webinar. Thanks for hopping on. We are in, okay, quick backstory. What is a seller's market? It is when you have 6 months or more supply of homes. What does that mean? That means if no new houses were listed for sale, how long would it be before we ran out of homes to sell? And if it's 6 months or more, we are in a buyer's market. If it's 6 months or less, we're in a seller's market. So as of this year, we're still in a strong seller's market with just 3 to 4 months supply of homes. Now, what we're seeing in real estate right now, why are prices so high? It all comes back to supply and demand. And I love this infographic because it paints the picture very vividly. You go from the 1940s to the baby boomer generation. Look how many people were born in America. We went from 9 million born in the 40s to 19 million born in the 50s. There's a huge amount of household formation as all these babies were being born. And look at the house production. Went from 10 million units that decade to 21 million units that decade. And every decade that followed, we were building 20 plus million housing units up until the 2010s. And the reason for this is a lot of these builders went bankrupt after the financial crisis and they couldn't afford to build anymore. Therefore, home construction dried up. There were no new starts and we didn't stop having babies. There was 27 million people born in that decade. That's a lot of families, a lot of kids, a lot of people coming here wanting homes, but there wasn't that construction. Then we've got the three L's, I call them land, labor, lumber. This is all driving the cost of real estate. First, lumber costs spiked, especially during COVID. You used to be able to build 10 houses with 50K worth of lumber. In the height of the COVID shortages on supplies, you could only build 2.5 houses with 50K worth of lumber. Lumber prices have modulated. They've come back down, but it's still very expensive. Labor shortages. Costs went up 4.4% last year. And if you've ever hired a contractor to do anything, it's very expensive. So labor has gone up, lumber, all the materials have gone up. It's not just lumber, it's roof materials, it's framing, it's nails, it's drywall. Every cost has gone up. And those are all the materials that go into the homes. Then there's the land shortage. And here on the Central Coast, we are very constrained. We have very limited space to go and build out because there are a lot of protected lands around like San Luis Obispo or the coast. And so you can't really build in a lot of these areas very easily. And so if you look at like land values and structure values, if you go to like Bakersfield or Fresno, you can see here that the land is a smaller percentage of the total value of the asset compared to like LA or San Francisco. The land values are much, much higher. And the structure still adds a great deal of value as well. So, land. We have a shortage of land on the Central Coast, and these are the factors that are driving up prices. And why buy real estate? This is another one of my favorite graphs to share because it goes back to 1960 and it tracks the median sales price of houses in the United States. Back in 1960, you could get a house for $16,000. Wouldn't that be nice? I mean, please, I'll take five, right? Just like, let's get houses for that price. Well, if you told your grandparents that that house would one day be worth on average $400,000, do you think they would have believed you? Probably not. They probably would have thought, wow, that is absolutely crazy. I cannot fathom my $16,000 house one day be worth, you know, 400,000. That's a huge multiple. Over time, real estate has done well even in periods of recession, which are these gray bars. The only times we see real estate take a dip, barely here, 1990s, and then right here in 2008. And this was a real estate recession caused by bad financing. Unfortunately, people were getting loans that shouldn't have been getting loans, and there weren't jobs to support. So you had demand dry up, you had an oversupply of homes, and what that created, a lot of foreclosures, huge supply of homes available, but no one could buy them. Prices did come down during that period of time. But since then, real estate has recovered and rebounded, and it's done incredibly well, especially after COVID, where they printed 1/3 of all bills in circulation from 2020 to 2022. And so that 30% inflation bumped up the real estate prices massively because real estate is a hedge against inflation. And so if you have cash sitting in a bank account, it's losing value, depleting over time versus real estate. Your money is in the market, in the house, and it will be that hedge protecting you. So some other things I like about real estate as an investment is it gives you financial security because you have a roof over your head and you own it versus having to rent it. If you rent it, you can't do what you want. You can't have pets, you can't drill holes in the wall, paint it, move around, doing things you want. And so owning it gives you the ability to make it your own. And you have that financial security that your landlord's not going to sell it from out from under you or kick you out or raise the rents every single year because you have a fixed rate mortgage. Then it's also a tangible asset that builds wealth for you over time. There's a few ways real estate builds wealth. And first of all is principal pay down. So instead of throwing your money away every single month, paying someone else's mortgage, paying your landlord, putting money in their pocket, you can actually bring that money back to your pocket by paying down the principal on that mortgage and building wealth. This is huge. And then there's tax write-offs. You actually get to write off the interest on your mortgage as well as property taxes up to a certain amount. And so what a lot of people don't realize is you get the principal benefit, you get the tax write-off. So if you do a tax adjusted payment, sometimes you take those two things into play and it could be equal to or put you in a better position than what you're paying in rent. And then if you keep it as a rental property, which I'm a big fan of buy and hold investing, get your foot in the door, keep that property as a rental, and then go out and buy another one. You can rent it out and get positive cash flow And that cash flow can help you go and buy another rental property, which or another home, which is fantastic. And then you also get to do what's called depreciation, where you get to do a write-off on the property as it depreciates over time. So there's all these benefits to owning real estate. And then you get to do DIY projects. You can build it the way you want and you can get sweat equity over time. So inflation is up across the board. You could see what the last few years have done. And this is why real estate, again, is a hedge against inflation. So important. And I snapped a photo of this at a real estate conference I went to. It just kind of blew my mind because we oftentimes let the news dictate what is going on. And we think that, okay, the headlines say it's a bad time to buy real estate, the market's falling. Right now, the headlines say there's more sellers than buyers nationwide. And instead of getting caught up in the headlines on what's going on nationwide, it's really important you look at the market trends for your neighborhood and what's actually going on locally here. So some of these headlines over the past several years, in October 2015, housing today, a bubble larger than 2006. Well, that year, real estate prices went up 5%. The next one, we're in a new housing bubble. Prices went up 5.4% that year. Home ownership doesn't build wealth, study finds. Prices went up 6.1% that year. It's better to rent than to buy in today's housing market. 4.1% price appreciation. The housing market is about to shift in a bad way for buyers. 4% price appreciation that year. And then 2019, 16%, and 21, 18%. So if we had been listening to the headlines, we would have missed out on the price appreciation going from $300,000 to $523,000 in value in that period of time, given the numbers here. And then this is so cool. I like this graph as well because it shows you the percentage of assets held by income brackets. So if you go to the bottom 5%, 50% of US households, like this is based on net worth, 49% of those individuals have their real estate as their net worth is mostly invested in their real estate. You go up to the next 50 to 90%, 39% of their net worth is held in their real estate. So for 90% of Americans, the majority of their net worth is tied up in their real estate, which is their primary residence typically. Or it could be some rental properties as well. Once you get up into the top 10%, you can see here that their net worth is held in varying amounts of corporate equities and private businesses, that kind of thing. Like the top 0.1%, they have a huge amount of their net worth in their corporate equities and mutual funds and shares, but they still have 9% of their wealth in real estate. So this just paints the picture that real estate is one of the best wealth building tools out there for the average American. Top 90%, that's what the majority of their net worth is held in. And this plays out again over here where you look at the median net worth of owners versus renters. And this was from 2025. Average net worth of a renter was $10,000. The average net worth of a homeowner was $430,000. That's 43 times higher net worth. And why does net worth matter? Net worth matters because it gives you options. It gives you financial freedom and flexibility to live your life on your terms. It means if you had to sell every single thing out there that you owned, how much would you have at the end of the day? The renter would only have $10,000. The homeowner would have $430,000. That gives them a lot more runway to go and do what they need to do. It's their nest egg. It's something that gives them that financial stability and security. Now, here's the profile of a first-time buyer. And this is really discouraging. You may have seen this in the headlines. So today, the share of home buyers, first-time home buyers is only 21% of that, meaning most buyers have already owned a home or they own property, they're older. So 21%, this is kind of one of the smaller metrics we've seen in history. And this is the really discouraging part. 40 is the median age of the first-time home buyer. 40. It's more expensive and it's taking people longer to get in the door. And 32% had children under 18. So I think this is really interesting too. 50% of first-time buyers were married couples and makes sense. They want to have a family, put down roots. But then look at this. 25% of first-time buyers were single women and only 10% were single men. And I'm saying, men, what are you doing? Why aren't you getting out there and buying homes? The women are beating us. You got to go out there, get married, get a house, put down roots. And I really want to challenge men out there to step up their game because it seems to me like there is this extended adolescence, this fear of commitment, of putting down roots. And women are stepping up and buying their own homes. They're doing it because men aren't stepping up and getting married. So, my takeaway, get married, buy real estate, have a family. Now, here's the thing that the Schwaegerle team did. This is based on last year's numbers for us. The average age of the first-time home buyers the Schwaegerle team worked with was actually 30.94. So we shaved almost a decade off of the national average. We are helping young people get in. So average is 30 versus the national average is 40. And 39% of the buyers we worked with last year were first-time buyers. So we actually specialize in first-time buyers and do a lot more first-time buyer business than the average agent out there. And the reason is because of our process, which we're about to go through. Here is the home buying process in 8 simple steps. This is what's going to help you get all that you need to know to buy a home. And if you want access to our free ebook that we created that has your complete guide to the home ownership process, send us a comment and say home, and we will get you that free ebook. And just comment below and we'll make sure to get you a copy of that free ebook on the full length process. It's a book Camille, my wife, and I, we wrote. It's about 27 pages and it's jam-packed with everything we've learned from our own journey buying a home to what we've learned helping now over 300 families buying and selling property here on the Central Coast. All right, so step 1 is partner with a great agent. This is really key, really important because there's over 1,200 agents on the Central Coast. And if you go to Santa Maria, it's like closer to 2,000 agents here serving the Central Coast. And each year, there's not that many home sales. It's like 2,500, 4,000 home sales per year. So the average agent isn't doing a ton of business. And what that means is everybody knows an agent, but to actually know an agent who is in production and knows the market and knows the trends, how to get your offer accepted, that's a huge differentiator. So you want to make sure to interview the agent and find out who they are, what they do, and if they have a good track record serving the types of people like you and what you're looking for. Okay, so and that is a key step because before you even go out to tour property these days, you actually need to have a signed buyer agency agreement. That's a new law from 2024, nationwide industry standard. You do need to have signed representation prior to engaging in going on showing tours. So that's really key. So we recommend sit down with an agent for that initial consultation so that way you know what to do. Okay, step 2, get pre-approved for a loan. And this is where we have our wonderful lender, Kim Rivas, on the call, and she's going to be sharing all of the strategies on financing that have helped so many of our clients get in, especially first-time homebuyer clients. So getting pre-approved for a loan is not as scary as it sounds. A lot of times people say, I don't want to talk to the lender. I don't want my credit to get dinged. I'm afraid. And honestly, it's never too early to talk to a lender. The sooner you talk to the lender and just have that conversation, the sooner you will know your numbers. They can break down what your monthly payment is going to be and what your closing costs and down payments actually need to be to get you into the home that you can comfortably afford. We never want you to see a home and be like, I love it, I want to buy it, and then find out I can't actually buy it. That's why step 2 is getting pre-approved for a loan before you go and like tour properties, before you go to open houses and fall in love with something really cool. You got to know your numbers. We don't want you to have the heartache of missing out on a home that you fell in love with, but was just out of reach. Okay, so that's step 2. Step 3, this is the fun part, finding your new home. That's where we will hook you up directly to the multiple listing service. So you'll have realtor-like access. You'll be able to browse homes at your leisure from your computer. We have a mobile web search app as well. And the cool things about our app and our website is it's directly linked to the multiple listing service with no lag time. So you will be able to see new listings in the same time and speed as a realtor. And what's also cool is the information is not being sold to multiple different vendors out there. It goes directly to us. So if you ask for a showing, it will notify our team. If you ask for reports, we get notified. If you put a favorite star on it, I'll know more about what you like. And our website is empowered by AI. And so it helps us source the listings we're sending you. And so the more you use it, the more you favorite properties that you like, the more we can send you the listings that are a good match for you based on your likes and criteria. So yeah, we can get you hooked up to that MLS search app. The other thing is, this is what the MLS looks on the back end, and we check the hot sheets. So weekly, we're looking for opportunities. So things we recommend, look at high days on market. Those deals, sometimes 1,000+ days on market, those are really big opportunities for us because that shows that they haven't sold, which means they're probably overpriced. Coming soon listings. Not all of the big websites get the coming soon listings. This is really key why the MLS is a great source of the data. And you'll be able to see on here things that aren't available online. These homes are available for offers, but they're not available for showings yet. They're coming soon. Then there's back on markets. My wife and I have actually bought property that fell out of escrow and they were back on market. And it became a better deal because the sellers were highly motivated to sell. They thought the house was sold, it fell out of escrow, the buyer canceled, and then they're more motivated to close. And so you can get better deals on that. Then there's other key search terms we can use to find motivation, like fixture upper, needs TLC, estate sale, relocation, contractor. There's all these terms we can use, key terms that help us find these distressed properties and better opportunities. Okay, step 4, make your offer. So you've already been pre-approved, you know what your finances are, and this is why it's so key because sometimes the best homes, they hit the market and they go in just a few days. And so if you don't have your pre-approval letter, you're going to miss out because there are people who are already lined up that are pre-approved or cash, and we might be competing with that. So making your offer is really important. What's the price we're going to put in there? What's the escrow length, the earnest money deposit, and our contingencies? So we'll negotiate. We'll find out where the sellers are at, if they have multiple offers. We'll find out if we need to compete by coming in over asking or be right at asking. We can run comps beforehand too, so we know what the market is telling us where we should be. And then we get it under contract, and it's not over till it's over. So step 5 is our due diligence period. So if your offer is accepted, you have to deposit what's called your earnest money deposit into escrow. It's a portion of your down payment. So it's not the full down payment you're coming in with, it's just a portion of your down payment. And it's typically 1 to 3% of the purchase price. And so you have to have some funds liquid, and that's deposited within the first 3 days. So you have that time to get it into the escrow account. And then once we're under contract, we begin our due diligence. So we always recommend you get a home inspection, pest inspection as a bare minimum. And then the general inspector, he'll come out. He may say that there's some more things that should be checked out, like, oh, the roof is, needing to be inspected, or the foundation's in bad shape. So we will guide you through the due diligence process. We have a list of vendors we use all the time that we know and trust, and they can get out there quickly. They can give us quotes to repair, and then we go in and we negotiate. And we usually get our clients some concessions. The seller we can ask them to reduce the price to cover it, or give you a closing cost credit, or to actually do the repair work. So most of the time, they'll opt for a closing cost credit to help you bring less cash to the closing table. And that means you have those funds available to go and do that work yourself after we close escrow. So there is a very dialed in process that our team uses time and time again where we can save our clients and actually get them sometimes tens of thousands of dollars back in concessions. Okay, the other things that happen when we're under contract, we have to get the appraisal done because we want to make sure that the property is worth what you're paying for it. And right now, it's been really interesting for us because we're getting our clients' offers accepted, and several times the contract price is actually below the appraised value. We're like picking up properties, getting good deals, and the buyer already has equity built in day one. Kim and I have one under contract now that just appraised $50,000 higher than our clients are getting it for, which means, sweet, that's just equity in the buyer's pocket. And that's why I think now is also a great time to buy, because people are picking up on deals that have been sitting on the market for a long time. And if you negotiate and you're patient, you can actually get a really good deal right now. Steps to know before you close: getting your funds transferred and make sure that all your contingencies are resolved. Then we release contingencies. You go in for closing day, you sign, and then you get keys to your new home. Congratulations. I know that's a lot. There's over 180 steps in the real estate process, and we have these checklists that we go through every single time to make sure that nothing slips through the cracks. So you'll be in good hands with a team like us. So what does the actual timeline look like? This is start to finish what you can expect. The fastest we've seen is like 45 days from meeting with us to being able to close on their new home. But more often than not, most people we meet with are 6 to 18 months out from actually making a move. So whether it's 5 weeks from now or even 5 years from now, it's never too early to meet with us and sit down to make that game plan and start the process. We have a lot of first time buyer reviews on our business page. You can check us out over here and see what they've all had to say. Here's my wife and I, our story. We were first time home buyers once upon a time, and we thought, how could anyone ever buy real estate? It's just so expensive in California. We came up with a strategy we thought that would help us get in. It was called house hacking, and you basically buy a multifamily unit. So this was a fourplex that we saw. It was on the market. It was a big fixer-upper, needed a lot of work. And we were like, okay, can we buy this thing? We had gotten approved with a lender that just did a really quick job saying, yep, you're good to go, whatever. And then when it came time to actually do the loan, he couldn't get us the loan. And we were in a mad scramble, like, oh my gosh, we're under contract. We need to close on this house. So we called Kim Rivas, and she's the lender on the call today, and she helped save the deal for us. So if it wasn't for Kim and her team and the ability for her to broker that deal and get that loan for us, we wouldn't have been able to get in on our first time home. So we are forever grateful to Kim Rivas for being able to help save this deal. And here we are. We were happy first time buyers. And it was a fixer upper. So here was some before and after pictures of it. We had to do a lot of this ourselves, just building sweat equity. We tried to scrimp and save as much as we could, and we did. We made it look cute, and that was my wife's number one criteria. She wanted it to look cute. And so we got it cute. We renovated another unit, got it rented out. And as we were fixing it, we fixed each unit up over time as there was a turnover. We were able to raise the rents, and we were able to live rent free at this property. And we share our whole story on our podcast, the Happy House Hacking Podcast. You can check out our YouTube channel at the Schwaegerle team as well. We're trying to grow the subscription base. We're up to like 430 people. The goal is to get it to 1,000. So please like and subscribe to our YouTube page, and share this video with someone else who might need it. And with that, I'm going to hand it off to Kim, who is going to tell us more about financing.
Thank you so much, Owen. I'm going to go ahead and share my screen here. Bear with me just 1 second. Get it up. All right. Can y'all see that okay? Yeah. Okay. Perfect. So thank you so much for the introduction, Owen. I'm happy to be here this evening. I kind of have a story like Owen's and why I got into the business and do what I do and love helping first-time home buyers purchase their first home, because it is one of the biggest investments that you'll ever make. And so it's super important that you have an agent that you can trust, a financial person that you can trust, to help kind of guide you through the entire process because you're going to have a ton of questions. So hopefully we'll give you a little bit of oversight into the financing part of it. And then what we like to do is set up an individualized appointment with you and do the actual pre-approval. So a little bit about me. Katie Capital is my company. We've been in business since 2009. And so I've been in the business actually since '04, but opened my own company in 2009. We are a broker slash banker. So what that means is we fund the majority of our own loans in-house, which is good because we have the flexibility to do things a little bit quicker than, say, a regular bank. But we also have the flexibility to be able to shop for your loan between 20 and 30 different banks that we use. So I love having that flexibility. I've worked at banks and with brokers, and I love having the ability to kind of do both. So we are available 7 days a week. We have an office, but most of our meetings are over the phone, but I do like to meet with first time buyers in person if I can, just because there's a lot of questions that happen, and I'm a visual learner, so I know some people it's a lot easier to meet in person, so we're happy to do that as well. So one of the things that we talk about in our pre-approval is, what does the homeownership portion mean to you? Is it about stability, being able to be in the same house and not have to worry about, you know, the landlord raising your rent or getting a notice that you're going to have to move because they're selling it or moving back in, whatever that might be. So that stability may be something that's very important to you. As Owen went over before, building wealth, you can see from all of that information that he shared with you that building wealth, real estate can be a huge part of that. The tax benefits, there's quite a few tax benefits that you can take advantage of when you own property, whether that's your first house or if you decide to have investment property along the way. Or is it just owning something that you don't have to worry about, again, renting somewhere? All of those things can be accomplished by buying your first home, and that's what we're here to help you do. So one of the things that I love to show an example of is rent versus buy. And if you'll see here, it's going to show first a cash flow difference. So being that we're in San Luis Obispo County, which is, as you guys probably know, a somewhat expensive county, we may pay a little bit more for a mortgage than we might for rent. However, I'm going to show you why that actually can be to your benefit. So this looks at your net gain of buying a home over 5 years, 6 years, all the way up until 10 years. So if we just look at a 5 year, because average home buyer is probably moving every 5 to 7 years. So let's say we start with 5 years. After 5 years of paying a mortgage, if you were to go and sell your home, you would net out about $74,000 versus renting, you're going to be at zero. Okay, you're going to have no equity to show for renting. So over 5 years, you'll gain $136,000 of appreciation. $34,000 of that will be paying down on the mortgage. And that will net out after you pay, you know, all of the expenses, the cash flow difference, and your initial estimated closing costs, you're still going to net out about $74,000. So I love showing this because even though it may cost you a little bit more per month renting versus buying, your net gain is going to be substantial overall. And we can personalize this to show you versus what you're renting now versus what it can cost you based on individual homes that you want to look at. The other thing that we like to talk about is the cost of waiting. And I've had a lot of clients, especially coming out of 22, 23, because rates were incredibly low, the lowest that they've ever been pretty much. And coming out of that, we said a lot of people were going to wait because rates had gone up and they wanted to wait for the rates to come back down. But that can be expensive. First thing is rates have not come back down. substantially from where they're at. They have moderated a bit and are lower than the average cost of a mortgage over the last 50 years, but they haven't gone back down to the 2, 3, 4, even 5% range yet. And so that waiting, for instance, I had a client in May of 2024. He was in contract on a home for 620,000. Decided I don't want to do this. I'm just going to wait. Came back this year. Same style house that he was going to buy, same square footage, kind of same neighborhood. That same home was going to cost him about $45,000 more. So interest rates, fortunately enough, were about the same, but it ended up costing him more in a mortgage because the price had gone up, more in a down payment. Um, he lost 45,000 in equity had he bought it a couple of years ago, and in paying down the loan. So in all total, he had lost about $55,000 just by waiting for 2 years. So that's something really that is what we want to look at is, do we want to wait for rates to come back down, or that may not happen. Nothing's guaranteed, or do we do it now as long as we're comfortable with that payment? So something we can always talk about, but it's good to look at what the cost of waiting potentially could be. Getting in is easy. We like to say it's easy because I think that the process that we try to help you with, educating you on the process, Owen and his staff taking you through all of the steps that you need to know. This really is about educating you on the entire process so you feel comfortable with the decisions that you're making. And that's why I say getting in is easy, because I feel that we do a really good job at that. And there's so many things that exist out there to help first-time home buyers. You just might not know about all of them. So there's still no down and low down payment options. There are down payment assistance options available. The seller can help with closing costs and commissions. There are programs available to lower your initial monthly payments. And you don't have to have perfect credit to do all this. So that's why we say getting in is easy, and we're going to show you some of these programs that help you get into a home without having the 20% or 10% or even 5% down to help you get in. So like Owen said, talking to your agent first and having that initial meeting, and then you want to get pre-qualified. That's going to give you direction and let you have a secondary meeting with your agent about what homes you want to be looking at, kind of narrowing that focus as to your price range, the types of homes. And when we do the pre-qualification, we're going to talk about all of that. So your down payment is the first thing we talk about, or no down payment, whatever that might be, where your credit scores are at, your debt to income, your job stability, how long you've been on the job, and reserves. And reserves is just what you might have saved, what you might have in retirement. Reserves aren't necessarily required, but sometimes they're a good compensating factor when we do a loan. So we're going to look at all of that and come up with a plan for you. So why do you want to get pre-approved? I think Owen mentioned some of these things, but it's really important that you do that before you do start looking at homes. So you know what price range you want to look in. You are able to make an offer as soon as you find the home. That's really important because you're going to be out looking when most people aren't working. Again, we're available on weekends and evenings, but just this last weekend, I had a client on a 3-day weekend. Hadn't talked to him before. The agent called and said, hey, I have a client. He wants to make an offer on this house, but he's not pre-approved. Can you get him pre-approved now so we can make the offer? It would have been a lot less stressful for them, not trying to gather documents and do all this on a 3-day weekend. So had he done it in advance, it makes that process a little more seamless. But regardless, we got it done, got him pre-approved, and he got his offer accepted all within a matter of about 24 hours. So to make that process a little easier, we'd like you to do that in advance. Sometimes it doesn't happen that way, but just being prepared as we can, we would advise that. We also have the ability to prepare an estimate for you for what your closing costs are going to cost you, and how we want to structure the package. Do we want to ask the seller to pay for closing costs if we're going to ask for that. Um, the seller's going to see that we're serious about buying because we're going to be able to give you a specific pre-approval letter for that property. So those are all really good reasons why we want to do this pre-approval process before you actually get into the process of going and physically looking at houses so you're ready to make an offer. What type of mortgage is right for you? That's the other thing we're going to talk about. It's not, and you're probably not going to be able to answer that question on your own unless you have a little bit of experience. So these are all questions that we're going to ask. How long are you going to live there? You know, do you want to have your mortgage paid off by a certain time? Is this, you think, your forever home, even though it's your first home? What are your long-term goals that are going to help us structure the best possible mortgage for you? And what's your current debt? Sometimes people come in and they may have a decent sized down payment. They may be getting a gift from their parents or they have some inheritance, but they have a lot of debt. And so we look at the cost of that debt versus the cost of having a little bit higher mortgage and see what the big picture is for them to kind of structure a mortgage that's right for them. Maybe pay off some of that debt, but take a larger mortgage, but their cash flow is going to be a lot better by doing that. So we're going to look at all of that big picture to come up with the program that's right for you. So some of the loan programs that are available, and I always, for my first time buyers, I'm always going to talk about down payment assistance programs if they need that. Some of the grant programs that are available, like GSFA, there are repayment down payment assistance programs. Cal HFA, GSFA has a couple of different programs. Then there's conventional, FHA, VA, USDA. We also have programs for some of our self-employed buyers if they can't qualify, you know, in the normal way, which is with their tax returns and W-2s. Sometimes we can use bank statements. So there's just a lot of different things that are available, even more than what we list here, but these are just some of the more common ones that we use to help our first-time home buyers. Cal HFA, I'll go into a little more detail about that particular program first, and that is a 3.5% down payment assistance program. It is a loan. You don't make any payments on it. It accrues interest at 1% annually, and you pay it off when you either refinance the house or you go to sell. So there's no payment due while you're in the home. Unless you had that loan for 30 years, then they'd have you pay it off at that time. But most people end up refinancing at some point and paying it off or selling the home and it gets paid off at that point. Along with the 3.5% down payment assistance, you can get an additional 2% for closing costs, which is a great option as well. If we can't get the seller to pay any closing costs, we have that option to get that assistance. It allows the seller to pay for closing costs. It allows for us to look at doing rate buy downs. And so there's a lot of really good things about this program. We close a lot of these loans for first-time home buyers. It is strictly a first-time home buyer program. You do have to be a first-time home buyer. So that's why we're putting us on this call, because it's one of our favorite programs for our first-time buyers. So this is just an example of a loan that we closed recently, and this is with down payment assistance. So this is just kind of an estimate that we put together, very basic. This is a Cal HFA loan, and it's an FHA, which is 3.5% down. So you're going to see here, purchase price of $650. This is the estimated taxes, homeowner's insurance, and the monthly mortgage insurance, which is required on any loan that we're not putting 20% down on. So the base loan amount is $627,250, and then with FHA, there's always a funding fee that's added into the loan amount. So at the time, this was the current interest rate that we locked them in at. And, oh, sorry, come back here. So these are all the estimated closing costs. And you'll see here total closing costs are about $20,000 on this particular loan. The down payment would be $22,750. That down payment is covered by the down payment assistance. Okay, so if we, in addition to that, did the closing cost assistance, that would be an additional $13,000. You would only need to come in with about $7,000. Now, that could also be covered by an additional assistance or seller credit. So you literally could get in with $0 down, $0 for closing costs if we structure it that way. So just kind of want to give you a realistic picture of how that program kind of works. Um, GFSA is another one of our down payment assistance programs. I actually have a couple of these going right now. They have a couple of different options. They have 3.5% down all the way up to 5% down payment assistance. They have the down payment assistance that's used can either be a second that you repay, or it can be a second that gets deferred, where it means there's no payments on it. And after 3 years, it actually gets forgiven. There are special qualifications that I'll go over for that, but it's a pretty amazing program if you qualify. Sellers allowed to pay closing costs. We can do the rate buy downs, and it works with a VA, an FHA, conventional, and a USDA loan. So this is another great program that we use quite a bit to help buyers get in. The down payment assistance, for the deferred down payment, what that means, again, no repayment on that second, and it gets forgiven after 3 years. You have to work for a member of, or work for a county that is listed here below. So if you work for one of those counties, you're automatically qualified. There are some other repayment ones that you can do, and those are open to any of these occupations, not necessarily work for the county, but any of these occupations. And this program right now, actually, they open this program up to everyone through June 30th. So even if you're not a peace officer, a firefighter, a teacher, they've opened this program up to anyone through the end of June, which is pretty awesome. So this is a program that we use quite a bit as well, just because we live in a county with correctional workers, hospitals, all of that. So it's a good program as well. Along with the down payment assistance, they actually, going back to the deferred program, they actually have a gift that they can give you that you don't have to pay back. And that's anywhere between 1 and 1.5%, or sorry, 0.5% and 1.5%. So it's a great option. And those are all things that we would go over with a pre-approval to see which one would fit you best. Some additional loan programs, VA loan if you're a veteran. One, thank you for your service, just coming off Memorial Weekend. VA loan is always 100% financing unless you choose to put a down payment, but VA will work with some of these other programs as well to help with closing cost assistance, specifically Cal HFA, GFSA. Those are programs that will help with closing costs if we couldn't get the seller to cover those. Conventional loans, if we just want to do a regular conventional loan, you can do as little as 3% down. A regular FHA loan is 3.5% down. And then USDA is one of my favorite programs, but it's a little more tricky to qualify for. It's something that we talk about, but that is 100% financing. It's got reduced mortgage insurance, which is pretty amazing. But it's a slightly smaller box to fit into than the majority of these other programs. So we love it. If it works, it's amazing, but it's a little bit harder to qualify for. So one of the other things that Owen and I have done some webinars before on is properties with ADUs. And a lot of properties now are either putting ADUs on, or there's already an existing ADU. And that's something as a first-time home buyer you may not be thinking about, but something that Owen has a lot of experience with and can talk to you about, how that works. But if the property does have an ADU, it's a great opportunity for you to maybe increase your price range a little bit, because we can use 75% of whatever that ADU would rent for in order to help you qualify. And you can still do it with some of the down payment assistance programs. You can do it with as little as 3% down or 3.5% down. So it's something that's a really good option, and definitely don't rule a property with an ADU out. It just gives you some more opportunity to purchase maybe a little bit higher purchase price. This is just a quick example. I did this with the 3% down, and then you could do 5% down. But purchase price, this would be the mortgage, taxes, and insurance, mortgage insurance. So this would be the estimated total payment. But if we have rent from an ADU that's say $1,500 a month, which is probably low for an ADU in our area, it would knock your actual payment down to this. So that's, again, just something to think about, get you into a little bit higher price range, maybe have a little bit more options, but keep your mortgage payment the same as it would be in that lower price point. So something Owen can definitely talk to you about, and we can talk to you about on the financing side of things. One of the tools that we like to use for getting your initial payments down is what we call a 2-1 buy down. And what is that? You might have heard of it, you might not, but a 2-1 buy down temporarily lowers your payment for the first 2 years. So let's say your interest rate is 6.5%. What we do is the first year of payments, we can get down to 4.5%, and that's what your payment is based off of for the first year. The second year, it goes to 5.5%. The third year through year 30, it will go to 6.5%. So there is a cost to do it, and I'll show you kind of the difference. So this is a good example of, say, purchase price $750. If we put 3% down, this would be the payment for the first year. And again, this is just the mortgage, not including taxes and insurance, but this is just the mortgage first year, second year, and then from 3 through 30. Why would we want to use this? One, it gets you in with a little bit lower payment to kind of ramp you up and get you comfortable with what your payment will eventually be. There's no secret, there's no hiding. This is what your payment will be after those 2 years, so you know exactly where it's going to be. So what type of situation does this work for? Maybe you're a couple and one of you is on maternity leave, and you're going to do that for a year, and then you're going back to work. But for that first year or two, we want that payment lower because we're going to be living off one income or an income with maybe some maternity leave or whatever that might be. Or maybe you're just getting a business started and you need to have the payment lower while you put those funds into your business rather than your mortgage. All of these things, and probably whatever else you can think of, are really good ideas to try to help you get into the house and make it a little more comfortable for those first few years. The other really great thing about a 2-1 buy down is, let's say interest rates tumble. We'll all keep our fingers crossed. But let's say they go down to 4.5% and we're in year 2 and we're like, oh my gosh, next year we're going to be at 6.5%. Well, if we're only in year 2 and we haven't used all of that buy down for that year, that money actually goes back towards your mortgage payoff. And so you actually, in a sense, will get that money back. If we refinance it at a lower rate for the entire 30 years, you can get some of that buy down money back. So you don't lose the money, and typically the buy down cost is going to come from a seller. We usually get that negotiated with the seller to pay. And I'll explain why we do that when we meet. There's kind of a whole series of things that we have to go through in order to make sure that works. But we usually put it on the seller to pay, and the sellers like that, believe it or not, because they don't have to lower their sales price. They don't have to go out and market it. We're saying, look, give us this credit, which is the savings is actually the cost. However much it's going to save us is the cost of the buy down. We have the seller pay that. You guys get the benefit of year 1, year 2 with a lower payment. And again, if you refinance before that year 3, some of that money will actually go towards your mortgage balance. So it ends up being a win-win for both parties. And actually, a lot of sellers use this to market their homes to try to get people to come in and buy it without having to do a price reduction. So it's a good tool. We like using it. And again, the cost of it, we try to get covered by the seller. And we can usually get that with good negotiating skills, which Owen and Camille definitely have that down. So it's good to work with someone who knows what these are and knows how to negotiate this for a buyer. So I don't know if you have any questions. I think we have the chat up or if you guys want to jump on and just ask questions. Um, this is all of my contact information. Happy to answer any questions you have. And if you'd like to schedule an appointment, just shoot me a call or a text and we can get you set up for pre-approval so you can start shopping.
Kim, what would you say is the most common down payment amount you see for first-time home buyers?
Ooh, I would say 3.5% is the most common. And
Cool.
that's if we're not doing down payment assistance.
Okay.
Yeah.
Nice.
Yeah.
And then are you seeing other trends with the appraisals? Like, I think we've had two now appraised. One was 50K above our
I
contract price. The other was 40K above our contract price.
yeah, I
So,
think that we are seeing them coming over what we call our contract price. Um, and even though we're still in somewhat of a seller's market, I feel like when we start to see that, we really are starting to see things shift a little bit into a little bit more of a buyer's market because we're getting the house for a little bit under contract price, which is great. But the house is still appraising, meaning that the value is still there at what the market value is. So when we do an appraisal, the appraiser has a copy of the contract. They know what the house is selling for, but they're going to appraise the value of the home based on comparable sales of that house. So like square footage, like area. And so even though our contract price is this and that's all we're trying to support, the appraiser brings it in above that because the value is actually there. So like you were saying earlier, the buyer has built-in value or equity when that appraisal comes in higher. So being that we're seeing that a little bit more is a good thing for buyers.
that's so cool. And then we are still, some of our listings are lingering longer, like that one in Paso that
Yes.
we were doing that one special loan program for. Could you share about that? Lender
Yeah,
buy down?
actually, yes, it's another program that is a buy down program. It's actually a 1-0 buy down, which means that the uh, the payment is lowered for just the first year, and then for years 2 through 30, it goes back to the regular rate. But the great thing about that is we don't have to have the seller pay the buy down. We're actually covering the buy down cost. It's a special that we have right now. And so it gets you in without having additional cost on your side or the seller side. So if we still needed to ask for closing costs paid by the seller, that's not an additional amount that we're adding on. But it gets you in, gets you a nice lower payment for that first year to kind of ease into home ownership, knowing what your payment's going to be in a year. So it's a great program that we have right now with one of our banks that they are paying for the lender pay buy down, which is pretty amazing.
Nice. Can you share about buying like a multifamily, having the income go towards it? What are the current rules in regards to like duplexes, triplexes, fourplexes? How much income needs to be there to support it, etc.?
Yeah, so that is very, very dependent upon the type of loan. So if you're doing an FHA loan and it's just a 2-unit or a duplex, as we call it, you can use 75% of the rents from the other unit. When we start getting into the 3 and 4 units, the property has to essentially be self-sufficient, meaning that your rents need to cover the mortgage or you have to qualify without the rents. So it's kind of a fine line on FHA of how we qualify you for that. However, with a conventional loan, you can do a multifamily up to 4 units with as little as 5% down, and we can use 75% of all of those rents. So it's a great opportunity. You were talking about your first purchase. I think that's how we did the 4-unit first purchase for you guys with 5% down. That program kind of went away for a little bit, and now they've brought it back where you can do a 5% down owner occupied conventional loan up to 4 units, which is amazing.
Yeah,
So,
so cool.
And having rents help you qualify is a bonus because with the price points that we're at, using 75% of that makes it much more within reach to be able to cover that mortgage payment.
Yeah. Are there any changes in legislation that you've seen in the last few years that might impact home buyers, people looking to buy homes?
Um, I don't think on the purchase side we're seeing too much of that. They're trying to get more people in, obviously, but I don't think we've seen the effects of that, with the
Hmm.
exception of these down payment assistance programs.
Yeah.
Um, there's no specific like tax credit that we're getting. Like in 2010, 2011, we had a $7,500 tax credit just for buying a house.
Oh, that's
So
cool.
yeah, it was pretty cool. So we haven't seen that come back yet, but we might. So nothing specific legislatively on the buyer side of things. There's some stuff on the selling side of things, but more so, and this is more your wheelhouse, is just, the buyer real estate agent agreement and how commissions are paid and
Hmm.
disclosed. I think that's probably the biggest thing that's hit our industry probably in the last
Hmm.
12 to 18 months.
And then how about the new deck inspection requirement for California? Like every six
Yes.
years, people who have 3+ units or even condos, HOAs,
Hmm.
are required to now investigate their decks. Can you share a little bit about that and what hiccups could come up on a transaction like that?
Yeah, absolutely. So I actually just did a webinar on this in January, so I'm very familiar with
Nice.
it. It's on our YouTube channel if you want to watch it. If you're interested in buying a condo specifically, or like Owen said, 3 to 4 units, which is considered residential, anything that has a deck, a balcony, stairway over a certain height, the HOA or the owner, if it's just a 3 unit and there's no HOA, is required to have what they call an SB 326 inspection. It has to be done by a licensed structural engineer or a licensed contractor to do that inspection to make sure that all of the decks, the railings, are all structurally sound and there's no deficiencies that would cause basically any harm. And so when these condos were all required to have that in place by January of 2026 to have that inspection done. Now, the reason why you want to work with an agent who knows about this stuff is because those are all questions that you're going to ask a condo association before we make an offer on a property, to make sure that, one, they have done the inspection for SB 326, and two, not only have they done the inspection, they need to have done all of the structural repairs, and not just for the unit you're purchasing. It has to be for the entire project. So it's really, really important that that's a question and information that you're getting up front as a buyer, because you don't want to get stuck in an HOA that hasn't planned for that, that hasn't budgeted, or hasn't done the repairs. I own a condo in San Luis Obispo, so I will tell you it can be very expensive if they do a total assessment and there's a lot of repairs that need to be done. And so it could be upwards, depending on the deck, of 10, 12,000 a unit if they come back and do all these inspections. But that's something that through your investigations, you're going to find out up front. And that's why the SB 326 inspection is really important to know about.
Yeah. Wow, that's big.
Yeah. Yeah,
Thank you for
it can
sharing.
be. Yeah. If you have any other questions on that, I'm happy to help. I've done a deep dive into that for a lot of our clients that have bought condos. So it's,
Awesome.
yeah, good information.
Caitlin, do you have any other questions for us? We'll make sure to send you a copy of that ebook you asked for in the chat.
Uh, Yeah, no questions at this time, but thank you so much for the information. I'm sorry that I didn't turn my video on. I'm still at work in
Oh,
the
no
You're
office. So I was
fine.
like, didn't
You're
want to,
fine.
yeah.
Thanks for
Um,
coming.
yeah, thanks for hosting.
Yes, thank you all for being here, and we'll post this to YouTube too and send that out so you can catch the recap later. And Caitlin, if you want to chat more about real estate anytime, we're happy to sit down and chat with you and help make a customized game plan to help you achieve your real estate goals.
Sounds great. Yeah, I will reach out.
All
Thank you
right.
so much.
Thank you so much for being here. And Kim, thank you again. We will
Thank
catch you
you.
all later.
All right,
Have a
take
good
care.
night. Thank
Bye
you.
bye.
Bye
Bye
bye.
bye.